In the world of investing, there are few names as revered and respected as Warren Buffett. As the founder of Berkshire Hathaway, he has become synonymous with unparalleled success in the field. Alongside his trusted partner, Vice Chairman Charlie Munger, Buffett has revolutionized the way we approach investing. Buffett's philosophy goes beyond simply picking stocks. It's about hand-picking exceptional businesses. In their recent annual shareholder letter, Buffett and Munger unveiled the secret sauce behind their achievements, investing in businesses with enduring economic advantages and trustworthy managers. This strategy, known as value investing, focuses on long-term ownership rather than short-term market fluctuations. But let's be clear, identifying winning businesses is no walk in the park. Fortunately, Munger has outlined 4 fundamental questions that guide their investment decisions. These questions act as a compass, ensuring careful consideration before committing their capital. Today, we dive into the minds of these investing legends, exploring their principles and strategies. Uncover the secrets behind their extraordinary success as we dissect their time-tested approach to making sound investment choices. Get ready to embark on an enlightening journey that will transform the way you think about investing. Do you understand the business? Investing in a business is not just about understanding what it does and how it serves its customers. According to Warren Buffett, one of the most successful investors, it's crucial to have an idea of where the company will be in the long run, maybe even in 10 years or more. He once said, "If you can't imagine owning a stock for 10 years, then you probably shouldn't own it for even 10 minutes." Buffett's company, Berkshire Hathaway, is famous for its careful approach to investing. They didn't invest in tech giants like Google and Amazon when they were starting out because Buffett wasn't confident in understanding how these businesses would make money in the long term. It was difficult for him to determine the true value of their stocks. However, Berkshire Hathaway has made successful investments in other well-established companies like American Express and Coca-Cola, which have paid off over time. This cautious approach means that Buffett and his partner, Charlie Munger, may miss out on some more risky investment opportunities. They are aware that they might not catch every profitable opportunity, and they accept that. For them, it's more important to focus on businesses they truly understand and believe in for the long haul. Does the business have a durable competitive advantage? When Warren Buffett talks about investing in successful businesses, he emphasizes the importance of something called a competitive advantage. He compares this advantage to a protective moat surrounding a strong and prosperous economic castle. So, what exactly is a competitive advantage? It's something that sets a company apart from its competitors and gives it an edge in the market. Think of it as a special quality that makes customers choose one company's products or services over others. Buffett believes that the stronger and more secure a company's competitive advantage, the more likely it will thrive for a long time, even decades. A competitive advantage can take different forms. For example, it could be a powerful brand name that people trust and are always willing to pay for, like Coca-Cola. When you think of soda, Coca-Cola is probably one of the first names that come to mind. That brand strength gives them an advantage over other soda companies. Another example of a competitive advantage is having a unique and effective way of doing business. Let's take Geico, an insurance company that Buffett's Berkshire Hathaway owns. Geico sells insurance directly to consumers, bypassing traditional insurance brokerages. This business model allows them to offer competitive prices and provide a more streamlined experience to customers. By doing things differently, Geico gains an advantage over other insurance companies. In essence, a competitive advantage is what makes a company stand out in the market and helps it succeed in the long run. It can be a strong brand, a unique business model, or any other factor that gives a company an edge over its rivals. Does the business's management have integrity and talent? According to Warren Buffett, there are 3 important qualities he looks for in a manager or leader: intelligence, initiative, and integrity. However, out of these 3, integrity matters the most to him. In fact, he once said that if he had to choose someone without integrity, he would prefer them to be lazy and unintelligent. Integrity is crucial because it means being honest, ethical, and doing the right thing, even when no one is watching. Buffett believes that if a person lacks integrity, it's difficult to trust them or rely on their judgment. In a 1989 shareholder letter, he stated that he and his partner, Charlie Munger, don't want to work with managers who lack admirable qualities, regardless of how promising their business prospects may be. In other words, they prioritize integrity over potential financial gains. When a leader has integrity, it fosters trust between them and Buffett. This trust is essential because it allows Buffett and Munger to give their leaders autonomy and not micromanage every decision they make. They prefer to find capable individuals who have proven themselves as successful leaders, what Buffett calls the .400 hitters, a baseball reference to top performers, and then let them do their job without interference. Buffett's philosophy is based on the belief that by selecting leaders with integrity, he can place trust in their decision-making abilities and let them operate independently. This approach allows them to focus on bigger strategic decisions and the overall direction of the company. Does the price make sense? When Warren Buffett and Charlie Munger invest, they look for companies that they believe are undervalued, meaning their stock price is lower than what they think the company is truly worth. As passive investors, they are not interested in actively trading stocks for short-term gains. To determine the value of a company, Buffett and Munger consider factors like consistent earnings, strong cash flow, and low debt. Companies with these characteristics are more likely to have long-lasting earning potential. When they find a stock that seems to be priced lower than its actual value, they see it as an opportunity to buy. However, it's important to note that they don't solely focus on finding the cheapest stocks available. They also look for companies that they consider to be of high quality, even if the stock price is not heavily discounted. Their strategy is to invest in businesses for the long term, not just based on the current stock price. Buffett once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This means that they prioritize investing in excellent businesses with strong management, even if they have to pay a fair price for the stock. So when Buffett and Munger make investment decisions, they seek out companies that they believe are undervalued, but also have strong fundamentals and great management. By investing in such first-class businesses, they aim to achieve long-term success. Thanks for watching. Creating valuable content requires effort and dedication. Please subscribe, like, and share our videos to motivate us in producing more valuable content for you. Thank you for being a part of our journey.